that nice 401k balance you're proud of, it's lying to you. Yep, straight up lying to you. Here's why. Because the number you see today is not the number you'll live on in retirement. Here's the good news. You can fix it today. I'm Dakota Grady, DG the Money Coach, and I'm all about helping you to master your finances. Let's dive into the conversation. So you got a 401k and you see a big number, like, woohoo, I'm going to retire and be comfortable. Maybe not. In fact, the three things that you're missing that people don't talk about regarding your 401k. First thing is inflation. Inflation is simply when prices go up. I remember back in the day when my mom and dad used to go to the store, we used to get gas in our car, right? We had like a station wagon. And gas used to be like 79, 89, 99 cents back in the day. So I'm telling my age. But now it's like $2 or $3 for a gallon of gas. So gas prices have 3x basically over the time I've been alive, basically. So, I mean, now I heard back in the 70s it was like sky high, but still, the whole point is inflation is going to eat or decrease your buying power when you retire. So you got to take that into consideration when you retire and think about your lifestyle. Are you going to have lifestyle creep when you do retire? You're going to be traveling a whole lot, spend time with your grandkids, or spend a lot of money on them. So if you are, you'll have less buying power in, say, 20 or 30 years when you do retire. But think about inflation. Over time, prices go up. Like now, prices have skyrocketed for rents, home prices, food, gas, you name it, it's going up. So think about that when it comes to your retirement as well, your 401k. The second thing is taxes. So I do taxes too, in addition to personal finances. And I think people overlook taxes when it comes to their 401k. For example, if you have a regular 401k, you're basically putting your money into the account pre-tax. That means you're not paying taxes on that money. So you're putting money into your 401k and it grows over time. So you're not paying taxes. But when you take money out of the account, you will pay tax on that money. Depending on how much you've earned in your tax bracket, like right now, tax bracket is up to 37%. Depending on your income, you could possibly be taxed up to 37% of your income when you retire and when you take that money out. In fact, you're going to have to take out required minimum distributions. But that's another topic for itself. But the whole point is you will pay taxes on that. So I recommend if you take money out, at least hold with this, at least 10% of that money, because again, right now you're not withholding taxes on that money when you invest in your 401k. And the third thing is wages are flat, all right? Prices are going up, but people's incomes aren't going up at the rate as things are going up in terms of prices for, again, homes, talking about rent, also you're talking about food, gas, all the things that people buy, clothing, they have skyrocketed over time. And if you aren't increasing your income over time, and say you retire, and some people still have debt. So I had a couple I talked to earlier this year, and the guy wants to retire. He wanted to retire, I think, this year or the next year, but he has a mortgage on his house. So I'm like, all right, if your income is going to basically go down when you retire, for example, because you don't have the income that you would make when you're working a job, it's going to decrease. And that means it's going to cut into, meaning your home expenses are going to cut into your taxable income. So with that being said, if you don't have more income, say you don't have a side hustle, you'll be paying your bills out of your retirement income. You don't want to do that. You don't want to have a loan when you're in retirement. You want to be debt-free, enjoying life, spending time with your family, traveling, enjoying life that you earned by working 30, 40 years. I would recommend these three things right here to help with these, to offset inflation, taxes, and low wages. The first thing is have multiple accounts. If you have a Roth IRA, in addition to a 401k, or a traditional IRA, still you have multiple accounts as opposed to putting all your eggs in one basket and just having a 401k. You can have a Roth IRA or a traditional IRA outside of your job. That's right, I said it again. You can have a Roth IRA and a traditional IRA outside of your job. So you can have potentially 2 accounts and maybe 3 accounts with a brokerage account. The second thing is I recommend doing is tax planning. Meet with your tax professional at least every quarter, 6 months minimum, I would say. That way you can do a mid-year review, compare how much tax you paid in the prior year, do tax planning, and see how much you can give to a charitable organization that can reduce your tax liability if you itemize, of course. Also, you may be able to start a business. When you start a business, you can deduct your expenses, which reduces your taxable income. Also, there are tax credits you can take advantage of that reduces your tax liabilities. And the third thing is to, again, increase your income. Whether you're working on a job or a side hustle or whatever the case may be, or if you haven't retired yet, maximize your income as much as possible. Save, invest as much as possible too, but make sure that you are investing along the journey, but also somehow reducing your tax liability. I recommend, again, most importantly, that you invest. I hope this episode was helpful to you all. In fact, drop in the comments below if you need help with taxes or personal finances and you're struggling to handle your finances, drop in the chat mistakes, and I'll send you a free resource to help you better make decisions with your finances. If you want to continue to receive value about investing, personal finance, or crushing debt, watch that video, and I'll see you there.